Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me, Surabhi Upadhyay, and she's back. Hi.
Yes. Well, I'm back with the market still around 24,300, 400. I thought by the time I'll come back, it'll be 25,000, the rate at which things are going, right? But I think maybe some nerves as we get closer to the big event, the budget, some consolidation perhaps. And I guess banks continuing to be a bit of a trouble spot.
Oh, absolutely. We started off in the green. There was, a positive handover from the global markets. And Asia still up 1.5%. Yeah. But right now we are struggling a bit. The Nifty slipped about 150 points from the day's high, in the red now, 65 points lower on the Nifty. The Sensex is down close to about 300 points. The Nifty Bank is down 400 points now. So 3/4 of a percentage point lost in the Nifty Bank. HDFC Bank is the one which is dragging the markets the most. It's the top loser. HDFC Bank down 1.5%. But even ICICI Bank, there is a downgrade by Axis Securities on ICICI Bank. They're saying good growth story, but it's all in the price now. And ICICI Bank too, again, started trade higher, but now it's down nearly 1%. Axis Bank too, down close to about 1%.
Yeah, absolutely. So banks, like I said, are still a bit of the Achilles heel for the market. I mean, they fire up on that one day, but then ever since we had some of those business updates, particularly HDFC Bank's business update, I mean, it's just been sort of a slippery slope. Having said that, there are stocks in the broader market that are reacting quite well to news. One example would be Yes Bank, where there is a improvement in the outlook by one of the rating agencies on the bank securities. So the market's reading that quite well, 4.5% up on that stock. Shalby has acquired another big hospital, and again, the market's giving it a thumbs up. There's about a 3.5% pop on Shalby for what it's worth right now. Tata Elxsi, of course, Reema has been telling us a little disappointing on the margins front. And again, there's about a 2% cut. So basically, it's a lot of reaction to the earnings that have started trickling in, as well as specific news points. But beyond that, looking at some of the movers and shakers, some of the PSUs are still finding traction. Case in point would be something like an REC, RVNL, which is up about 3.5% as we speak. Coal India is having a very good session today, by the way, 3% up on Coal India, ONGC. So the larger PSUs are actually having a pretty decent day, and that's how it's shaping up for the time.
SCI is the PSU which we should highlight. Yeah. SCI is up 19%. I think there was an article which came out about, yesterday, where SCI and NMDC Steel are in advanced stages of a strategic sale. They're awaiting the nod from the PMO. It's a report. We've not confirmed the story, but that's gotten the stock excited. NMDC Steel is the one we're talking about, and SCI is up nearly 19%.
In fact, even SCI Land and Assets, yes. I mean, 15% up over there. So some of these potential strategic moves really powering up PSU stocks. Okay, so let's get going. There's lots lined up on the show today. We're going to get you a full-blown discussion on taxation and what is it that the street is bracing for. Capital gains taxes on everyone's mind. But before we get to that discussion and some of the other stuff that we've lined up, today is a big blockbuster IT day. The season is kicking off with TCS. So Reema, take it away. How's it going to be? Or how could it possibly be?
Better than last quarter. Let's put it like that, right? Dollar revenue growth is seen up 1.5% for TCS on a quarter-on-quarter basis. Remember, Q1 is a seasonally strong quarter. IT companies have been winning large deals. They're executing on that. So all that will flow through. And particularly for TCS, there was this big BSNL deal. So top-line growth is going to be better than what we've seen over the last couple of quarters. Margins for TCS could come under pressure, down 150 basis points because of a wage hike. Now, many IT companies have postponed their wage hike. They've delayed it. But TCS is giving all its employees an increment 1st of April, and that will weigh on the company's margins, down 150 basis points, putting pressure on the company's profits, and that's down nearly 4%. The TCV could be lower on a quarter-on-quarter basis. If you remember, TCV stands for total contract wins, which is your new plus renewals. Last quarter, it was a blockbuster $13.2 billion, but that was boosted by one big insurance Aviva deal. So, analysts are saying that this quarter will also be healthy, maybe $8, $9, $10 billion in line with their quarterly run rate, but lower on a quarter-on-quarter basis. But, the street's not going to focus so much on numbers. It's going to focus on the pace of recovery for the industry. Does it happen in H2? Are we seeing some signs of life? Because expectations are that growth is going to pick up in FY25 a little bit, but more so in FY26. So I've compiled, the expectations for TCS in terms of constant currency revenue growth for this year and next year. And as you can see, largely the street is at 5.5% for this year, which compares with 3.4% last year. So a pickup in growth rate. But the big growth is going to come in FY26, where the street is baking in a recovery in demand. So is that going to play out, or will there be any changes to this? Secondly, even on margins, the street is penciling in that margins will improve over the next 2 years, FY25 and FY26. The reason being that the companies had overhired, attrition was very high, but now hiring has come down. Most companies have, like a company like TCS hasn't increased its bench strength in close to about 3 quarters. So that employee cost will come down, boosting companies' margins. And then again, other things like, competition from captive Gen AI centers, generative AI is going to be a hot topic of discussion, hiring, etc. All those softer aspects.
And it is TCS that 2 quarters back kind of hinted that there's some recovery or green shoots, at least in BFSI, right? They were the first of the block to at least say that there's some hint of a recovery.
It didn't really play out last quarter, and I think maybe we also, it took it more than latched on to it as a sign. But they did say last time that FY25 is going to be better than FY24. And that was a given because of the number of large deals they won. You just execute that and you're going to get a bump up in revenues. But, I think the amplitude of recovery is something the street's going to watch.
No, absolutely. And I think TCS is going to set the tone, as it's going to be all eyes on earnings season from now on. And that's what our market conversation is all about today. By the way, before we get to that, just a reminder, we'll be speaking to the TCS MD and CEO K. Krithivasan, CFO Samir Seksaria, and Chief Human Resources Officer Milind Lakkad tomorrow at 9:45 a.m. So make sure that's an interview you definitely want to catch. All the action right here on CNBC-TV18. And like I said, since we're talking earnings, let's kick off the market conversation as well. Nuvama Professional is expecting a moderate growth in sales as well as in profits after tax for Nifty companies in the first quarter. They're saying that the key earnings drivers would be perhaps telecom, driven by margin improvement, and a key drag in terms of sectors could be OMCs as well as banks. So let's take this ahead with Sandeep Rana of Nuvama. Sandeep, great to have you on. Thanks for joining in. Let's actually start with IT because, Rima was just pointing out what we can expect from TCS. Now, give us the overall number, what you're expecting from Nifty earnings, and within that, where is IT going to be? Is it going to play the role of a laggard that will pull down the overall average, or maybe it could be a bit of a helping hand this time?
Yeah. Hi, good morning. So if we just talk about the Nifty earning, yes, we know this time the numbers will be kind of little muted. See, we have to understand the base has been very strong. Last 2 years, in fact, we have seen very good growth. In fact, if I just see last year, it was around more than 20%. So we can't expect every time that we have, bumper growth. Talking about this time, I think that the growth will be muted. We are struggling maybe 7 to 8% overall growth. And yes, as you rightly said, OMCs will be a drag this time. Now, talking about telecom, I think talking about IT would be moderate. And we have seen that IT has not done too well in the last 1.5 years. What has done well is actually non-IT. Renewables, power, capital goods, they have done very well, defense. But I think IT will be a kind of moderate this time. It will not be a laggard for sure. It will be moderate. And I think mid-cap IT will be a little more interesting than the large-cap ITs that we generally talk about. And talking about TCS, I think TCS, again, we know the numbers, how the numbers will be. They will be kind of, they will be reasonable. I won't be saying it's bad at all.
Okay. What about private sector banks? There is so much opportunity and enthusiasm built into it, but they fail to deliver compared to street expectations. Investors, some of the large investors have sort of shunned the private sector banks, bringing down their holdings. And now some downgrades are coming through. I remember there was a Bank of America downgrade on HDFC Bank. Today, Axis Cap has downgraded ICICI Bank. They're saying it's a consistent performer, but it's getting fairly valued. And therefore, ICICI Bank is now an ad. And they also go on to say that the ROA this year will be lower than what we've seen in last year, or at least Q4 of last year. On private sector bank, do you think some optimism is now getting shaved?
I think banks, again, have not done too well. In fact, in BFSI space, non-banking has done very well. So that part has done exceedingly well, be it on the home finance side or the other side. But banking per se has not done, although the numbers have been very good. So if you see in fact, I was looking at 5 years age of the numbers, they have far exceeded the market cap. They have, the numbers that we see in the market cap. So of course, based on numbers also, private bank has not done too well. Now we know the big daddy SDFCs and all, they have not performed so well. But ICICI is reasonable. I think numbers also for ICICI are a little far better than most of the other large caps. Excess is also reasonable based on the numbers. But having said that, I think banks should do better than before. What we saw also in last, I think, 2 months, bank has actually done very well. I think that should continue going forward also. But more so, non-banking should be far better than the banking. That is what we are taking.
But just to expand on that point, on on banks, would you say, Sandeep, that some of these lackluster expectations, are they already in the price? Because that's the reason why we're not seeing a sustained massive bank rally, right? It's one step forward, 2 steps back. So is it largely in the price, or could it actually derail things from a stock and price perspective point of view? And what could be the biggest issues that come up with banks this season?
See, one thing that we know that during many companies come out with their operational numbers. So broadly, how the numbers would be. Surprises are less when the actual result comes in. So, you price in most of the things before the results. Like, how the revenue is moving up, except NP and all that, which is not there on those operational numbers. But most of the broader numbers are there. So, how the banks will react when the numbers are, unless there are some drastic change in the NPA and GNPA or in the other things. So, broadly, and that's why you don't see the reactions when the results are there. Having said that, I think private bank will do well. Reasonably well. So we are not worried on that.
All right, got it. So let's talk about another big pillar for the market that's not really fired till now, and that's consumer, FMCG, right? Last quarter, I remember, a lot of the numbers had started looking better, at least from extremely low single digit or flat. We started moving towards, mid-single digits. And the companies were sounding more positive as well in terms of rural recovery. So what is your expectation from the FMCG universe?
See, I'll tell you, I'll just give you a broad idea of what has happened. See, in market, you have limited money. Okay, I'm just a little digressing the subject. So you have limited money. Now you have to think, where will you put this money? And we know for the fact in last 1.5 years, the sectors which were doing well, which I said before also were capital goods, power, more so renewables. And, so stuff like where defense, infra. So people have to put their money and move out of from the sectors which are not that good. So it's not that FMCG was not doing well. It was doing reasonable, but there are far better sectors that you wanted to put money on. Now the question is, those sectors have become very expensive because we have seen in last 2 years, most of these companies have been 4-5x, multi-baggers. Now, thing is, I think the fund managers or people who are investors are kind of pruning that kind of money in capital goods or defense and getting into sectors like FMCG, which has not done very well, and the numbers are decent. See, numbers were never bad. But yeah, numbers were decent, but the stocks have not done well. So I think some kind of money flow will shift towards these kind of sectors. And I think in this market, sector rotation will happen. Maybe sectors like FMCG, some bit of good pharma companies which are reasonable at reasonable price. So that kind of things will happen, I think, next 1 or 2 months.
Do you want to talk about pharma? You said that some pharma stocks may deliver. Which ones in particular are looking good? Because expectations are quite high from pharma this time.
Right. So as Nuvama, like company like Lupin and all that we are pitching, and in that again, I will again digress and move to mid-cap companies because that is where we specialize in. So in pharma, there are a lot of mid-cap companies that are looking good, like 3D Bio and, Gina, Seco. There are a lot of pharma companies which are looking interesting to us in this space on the mid-cap side. So I think, again, on investing, I think we should look for companies which are growing at 20-25%. And there are many companies. Now, when we look at market, we say, Nifty is looking expensive. You're at 22-23 times FY25 and maybe 19-20 times FY26. So that way it looks expensive. But in those also, there are pockets of sectors and stocks which are looking good, which will grow at 25%. And they're reasonably available at maybe 1 pack. So nothing is cheap, like you're not getting anything a half pack or something. But yeah, 1 pack in this market is a little cheaper. So you will go for those kind of companies. Like in this also themes, if you want to play, like water is a very, very interesting theme still. Looks like, and they are at reasonable price. So I'm saying we still in this market have to look for those kind of companies which are, looking interesting, growing at 20-25%, and we are available to add maybe 1 pack or maybe the same kind of piece.
Thank you, Sandeep, for joining in. Need to get into a break. On the other side, we'll talk commodities with the birthday girl, Manisha Gupta.
Back here with us on Trading Hour, and it's time to talk commodities with the birthday girl. Manisha Gupta is in the house. So Manisha, it has to be all gold and silver and diamonds today, or maybe even cocoa, chocolate, right? That's what birthdays are made of.
Well, yes, they are, but the price...
Many happy returns of the day, first of all, to you.
Thank you so much, Surbi. Well, I'm talking about the crude oil prices, though, because we've seen some support come in for this one as well. Well, commodities for the year have been performing quite well. The first half was good. That is exactly what we saw for various precious metals, base metals, and the crude oil prices also, which, by the way, are up 5.5% in the matter of last 1 month itself. There is support because you're looking at geopolitical tensions. There are climate issues as well. The first hurricane of the season in the Atlantic also has been seen, and this year is being called extraordinary and very dangerous when it comes to hurricane. There are at least 14 named hurricanes that the season would be looking at. A bit of a decline in the US dollar index also has been supportive for the crude oil prices, and there are expectations that we perhaps are looking at a deficit in this quarter. There is a report from EIA suggesting that there is a deficit in the 2025 for sure. Also, when you look at the kind of production and consumption numbers that we are looking at for 2025, as you can see, there is a deficit, and that is what the markets are pricing in at this point in time. The OPEC report also has suggested demand growth in this year and in 2025 as well. That has been supportive for the markets there. The US inflation data is what the street will watch out for today. This would give you direction in sense of US Fed rate cuts expectation for the month of September and December as well. But ahead of that, we've seen support continue into the markets. The first half did see a gain of around 12.5%, and the street does anticipate that the second half of 2024 could perhaps outperform that.
Thank you very much for that. News coming in for Indegene about a strategic collaboration with Microsoft. The stock is up close to about 2%, one of the recent listings. Get into a short break, but before that, a quick programming note. Now, will the RBI cut rates this year? Is the RBI worried about a bubble in the stock market? And is India poised for a GDP upgrade? Well, this is the CNBC-TV18 mega exclusive, the definitive RBI governor interview, only on India's most watched business channel, so stay tuned for that. Welcome back. Ambuja Cement is higher in trade after brokerage firm Nomura upgraded the stock to a buy and raised the target price. Nigel joins in with the details. Nigel.
Well, that's right. Nomura's gone ahead and they've upgraded the stock to buy from reduce earlier. The target price moves up to around 780 rupees in comparison to 500 rupees earlier. The key factor that they have considered out here is they've raised the multiple. Earlier, they were giving it 14 times multiple. Now they're giving it at around 19 times multiple. Keep in mind for Ultratech, they assigned a multiple of close to around 17 times odd. The four big reasons that they've given. One is in terms of capacity addition. They are saying including Pennar, the total capacity addition for Ambuja Cements will be at around 14% CAGR in the next 2 years. That compares with around 9% for Ultratech Cement and around 6% for the industry on the whole. Now, they're also saying that they are budgeting that by FY26, Ambuja's capacity will go to around 106 million tons, and they've included Pennar in this calculation. The second point is they are foreseeing Ambuja Cements moving into new markets, which is good for them. So they're saying the Pennar's acquisition makes Ambuja Cement the third largest player in South India after Ramco as well as Ultratech Cement. They also go on to state that the two acquisitions that they've done, that is Sanghi as well as Pennar, comes with a lot of limestone. So they have that, that optionality where they can go ahead and add capacity because of this limestone reserves in new geographies as well. Point number 3, they are estimating volume growth for the coming years. That's for the next few years at around 13%. For FY24 to around FY26, they are talking about 13% growth for Ambuja Cements, excluding Pennar, mind you. And that compares with, for Ultratech, they are penciling around 11%, for the industry around 5%. So it will outgrow the industry in volumes. And the final point, which is point number 4, is the cost optimization measures. The management has been talking about domestic coal. They have been talking about alternate fuel, usage, as well as some group synergies. So put all this together, what they are penciling in is that they expect Ambuja to reduce their operating costs by close to 300 rupees per ton. So based on all these factors, Nomura is quite optimistic on the prospects of Ambuja Cements. Back to you.
Thank you very much for that. Let's move on to Yes Bank because that's surging in trade after Moody's upgraded their outlook on the stock. Abhishek is here to give us the details. Abhishek.
Well, Rima, as you mentioned, Moody's have upgraded the outlook on Yes Bank. Rating has been reaffirmed at BA3 on various instruments in the balance sheet of Yes Bank. So outlook has been raised to positive from stable. Now, the change in outlook actually reflects the expectation that has been met with respect to gradual improvement on fundamental basis on Yes Bank that Moody's has seen. So improvement in deposits and lending facilities that can improve the profitability going ahead over the next 12 to 18 months is what Moody's is expecting. They expect cost of funds, to remain higher for Yes Bank versus peers over the next 12 to 18 months as well. And they may upgrade ratings of the bank if they sustain their core profitability along with stable asset quality going ahead. Now, rating upgrade is possible if PPOP, that is operating profit to total asset, is sustained at 1.2% or above. So downgrade of Yes Bank's rating is unlikely over the next 12 to 18 months. That this is the first time that I am seeing that a rating agency is saying that downgrade is not possible for next 12 to 18 months, which is a good sign. Rating could be downgraded if at all CET1 ratio falls below the 10% level, and PPOP, that is operating profit to total asset, if that is sustained at 0.8% or below. Back to you.
Thank you very much for that. Here is a quick programming note. We have a big budget exclusive for you today at 3:30 p.m. The CNBC-TV18 CII Budget Town Hall and the entire top brass of the industry body will be in attendance. We will quiz them on their budget expectations. Sanjeev Puri, Sanjeev Bajaj, Sunil Kant Munjal, R. Mukundan, Chandrajit Banerjee, B. Tyagarajan, Shenu Agarwal, Vinod Agarwal, and many more will be speaking. We have been, speaking exclusively at the town hall for 25 years. CNBC-TV18 has been covering the budget, union budget. So keep it with your union, with your budget destination for all the big newsmakers and the exclusive news breaks. Welcome back. The CPSE, the PSUs are on fire today. The Nifty CPSE index is up close to about 1%. And I believe the PSE index has finally recovered all the losses that it made on 4th of June. Today, the top gainer on the Nifty is ONGC, one of the big movers that we've seen. So it's a 2% gain on that. Coal India is up 2.8%. BPCL has a gain of nearly 1.3%. So that's where all the action is. Apurva Sheth, as promised, from Samco Securities is now with us for a quick technical check on the markets. Apurva, morning. Thank you for joining in. How do you read the market? It appears to be very range-bound. And today we had positive global cues, but yet we didn't have the strength and the momentum to climb higher.
Thank you for inviting me on the show. So markets have had a tremendous dream run from the election day lows that we have seen. So from those lows, we are up more than 3,000 points, and Nifty has managed to close above its previous day's lows for 24 days in a row, and this is the longest streak that it has managed. Apart from this, if you look at the last 20 days percentage change on Nifty, it is more than 10%. And if you also plot a Bollinger Band, so then it is already trading close to its 2 standard deviation mark. So looking at all these things, I think that the markets are likely to remain range bound, or so Nifty is currently in no trade zone kind of a thing. And the resistance level for Nifty would be around 24,500. That is going to be a very crucial resistance level for the Nifty going forward.
Okay. What about stocks, Apurva?
So from the stocks perspective, I believe that mid caps are still having strong momentum. So CDSL is one stock that we have already recommended to our clients, and we believe that there's a lot of potential in the stock going forward from here. So the stop loss for CDSL would be 2268, and the target for CDSL in the short term would be 2540. And another stock would be Midhani. The stop loss for Midhani would be 495 and a target would be 600. Both of these stocks are moving out of consolidations and likely to head higher in the short to medium term.
Okay, thank you very much for that. On the other side is the big discussion on what should we expect on the taxation front. Will the government, will the budget tweak on the capital gains taxation? Will there be some relief on the personal tax front? All those discussions posed with Dinesh Kanabar, Kalpesh Maru and Pranav Saita on the other side. Welcome back. Let's talk about the taxation. Budget is 7 trading days ahead, and there is a lot of chatter and fear about what if there is some tweaks on the capital gains taxation front. Maybe increase the holding period from the current 1 year, or is there a possibility that the tax rate of 10% goes up? And I think there is fear, right, that if it comes through, there will be panic on the markets. Yeah. You've spoken to a lot of experts. Tell us.
When you said budget is 7 days away, it really made up sit
up
and take notice. I thought 23rd is still a while away.
Next week there is a holiday.
I didn't know that. That's the good news.
That's
okay,
we're
digressing.
Right? Listen, take that.
But coming back to the point, Rima, I think what you said is right. I think tax is really taking center stage in this budget because the last time was an interim one. It was just a vote on count. And there are sort of long-standing issues. One of them is, of course, one discussion point is going to be whether the government will put more money in the hands of people now that it has a fiscal headroom, and everyone's looking at the personal income tax regime, whether there will be any sweeteners there. But the second bigger perhaps issue from a market perspective is capital gains tax. Will we finally see some rationalization? And by rationalization, I don't necessarily mean a cut. More a simplification and a standardization of the capital gains regime. And that is what I think has the ask has been from the industry perspective, from the individual perspective, from tax experts' perspective, given the regime, which has, of course, multiple rates, multiple asset classes, different holding periods, 1 year, 2 year, 3 years, STT paid, not paid, and whether you get the indexation benefit or not. So can this budget give us the first step towards at least a simplification of what has traditionally been a slightly complicated regime? Well, we have a full house of tax experts joining in to decode this. So let me, of course, welcome our experts in. We have Mr. Dinesh Kanabar, CEO of Dhruva Advisors. We have Kalpesh Maru joining in from KPMG India and Pranav Saita from EY India. Gentlemen, good morning. Great to have you on. It's the usual discussion that we have in the run-up to a budget year after year. But I think the hopes are running a little higher this time around, given that the elections are behind us. Mr. Kanabar, let me throw the floor open to you. Let's deal with capital gains and then we'll deal with the rest of the tax expectations. But on capital gains, what should we, brace ourselves for?
Thank you for having me. And let me begin to say that you mentioned about rationalization, and indeed the entire capital gains tax regime tends to be very, very cumbersome. We have short-term, long-term, listed, unlisted security, residential houses, holding period, resident, non-resident, and we all know that. Sometimes I wonder as to whether when you are asking for rationalization, are you be careful about what you wish for? So, for example, many years ago, we were all talking about dividend distribution tax being paid by the company and being substituted by a dividend tax. And when that happened, people started to complain to say that high net worth individuals are now paying far more than what they were paying. So when you start about talking rationalization, the questions which you put up, which are the usual questions, will we see a 1 year go up? Will we see the rates go up? And I'm no expert. I don't understand markets. I understand taxes. Is there a need for rationalization? Yes. Is there a more important need for a stability? I would say yes. I think both as a part of FICCI and the conversations that I have had with the government, I mean to say that the need to communicate to the world is that India has a stable tax regime, and that is not going to be tinkered year on year on year. On your earlier point as to whether the threshold limits for exemption should go up, probably yes, because there is an inflation and maybe there needs to be an automatic application of an index to take care of the inflation. But insofar as a capital gains tax is concerned, if you go back and talk about rationalization and making it simple, maybe there is a need, but I would say that there is even a greater need to communicate stability, which I think is very important. What has happened is that we have seen huge number of IPOs in the last 1 year. And I think that's very welcome for the industry. It shows foreign investments coming in, it shows domestic investments coming in. And the last thing that the government should do or would want to do is to really rock that boat, which is settled down and is going very, very well. So from my part, rationalization very welcome. Is this the year? Maybe not.
Mr. Kanabar, I think you're being, careful, and perhaps for good reason. You're not putting numbers out there and specifics, but we're going to come down and, drill you further on that. Let me bring in the others as well. Mr. Saita, if I could come to you. Capital gains rationalization, we all talk about it. We all say we want it. The question is, what could be the right model? The specifics. So let's talk listed. Now, listed equity, the rate is 10% for long term, but the definitions are different. It's only 1 year. If it's unlisted, then it's 2 years. If it's property, then the definition is 2 years, and the rates also vary. So, if at all, you were to recommend to the government a formula to start simplifying and rationalizing this, where would one begin? What are the rates that you would move around?
Okay, thanks so much. So a very quick summary. There are so many different provisions right now that if even a person like me were to be asked a question on capital gains, I would have to go back, refer to the book before being sure what kind of rates, period of holding, and so on would apply. So it does call for some rationalization for sure. At the same time, without compromising, very correctly, as has been pointed out, the stability, predictability, which has been the hallmark of this government, not trying to do minimal tinkering of the laws all the time. That's been the hallmark, and that should continue. But I would feel 2-3 things can be done very simply. One could bracket assets maybe into 3 categories. One is risk-bearing financial assets. The other is other financial assets. And a third is all the other assets whatsoever. Just have these 3 baskets. When I say risk-bearing financial assets, I would normally put within it shares, equity-oriented mutual funds, and maybe REITs, InvIT units. So those are the 3 types of risk-bearing financial assets. All other financial assets I would put separately. And the third bucket would be other than financial assets, which would mostly be in the nature of gold, silver, jewelry, immobile properties, and so on and so forth, the entire rest of the bucket. I would feel the tax rates can be rationalized as, for the long term, 10% on the risk-bearing financial assets, 20% inclusive of the benefit of indexation for the other financial assets, and as well as 20% for the other third bucket. So the second and third bucket might be similar rates of taxation with indexation benefits. And so far as the period of holding is concerned, it could be rationalized as 12 months, or meaning 1 year, for the financial assets in total, whether it is risk-bearing or otherwise. And for all other assets, it could be, for example, 36 months. That, I think, would keep it very simple. The short-term capital gains tax rates could be 15% for the risk-bearing financial assets, and maybe the normal slab rates or whatever the regular rates of income tax might be for all the other categories of assets. That, I think, would be very simple, but at the same time address the need of stability, predictability, and fairness and transparency for all.
Pranav, so just for the sake of clarity, and I think you really simplified it. You're saying just bucket it into 3 separate categories of asset classes: risk-bearing financial assets, other financial assets which are non-risk-bearing, all other types of financial assets, and other assets which are non-financial assets, which is where your gold and perhaps a movable property can come in. You're saying 10% for risk-bearing and 20% each for the others. And in terms of the duration, how much did you say should risk-bearing be? Or should it be continued? Should it continue to be the present regime of 12?
All financial assets 12 months. Okay. Other than financial assets, gold, silver, jewelry, immobile property, 36 months.
36 months. So all financial assets defined short-term as less than 1 year, long-term as above 1 year, and 36 months for the other category. Got it. Thanks very much. So that's the EY take on maybe what could be a new model, which is simpler to deal with. Let's get the KPMG point of view as well. Mr. Maru, you just heard Pranav's recipe or Pranav's model. Would you concur, or if you would like to sort of add or delete or tinker around, what would your model be? Capital gains.
More or less, I would sort of concur with maybe one tweak. Really, we need less complexity than more. So I would just keep it as 2 buckets: financial assets, risk-bearing assets, everything which is securities at 12 months, 10% rate, and every other asset at 20% with indexation benefit and 3 years. Most importantly, I would emphasize what Dinesh talked about. Stability is the key. In the search for simplicity, I would urge and request the government to not find a mid path and increase the rate, let's say from 10 to 15, right? Which it goes against the very grain of stability that we've been working. So simplicity is needed, but do it in a manner that doesn't upset the current system. So 10 going up, and there have been some murmurs about it. I would strongly hope that doesn't happen.
Yeah, so the 10% should not go. I think that's the biggest demand from the equity market. Every participant we speak with, first up on their budget wish list is do not change capital gains taxation, the rate or the period, at least from a listed equity point of view. Gentlemen, we need to take a very, very quick break. We have more to discuss beyond capital gains as well. Rima has a lot more questions, especially on personal income tax. Coming back with just that.
Welcome back. This is the big budget discussion on the taxation front. And will the budget provide any tax relief for the common man? We've been in discussion with all our three experts. Mr. Kanabar, coming to you. The government has been trying to move away people to the new tax regime. They threw in a standard deduction of 50,000, but yet we haven't seen that shift away from the old regime to the new regime. Do you think in this budget this time we could see more by way of deductions or any sort of an exemptions for the new tax regime to make it more lucrative to enable that shift? And anything that, people who are on the old tax regime, should they be expecting anything?
So if you go back historically to the new tax regime for corporates, it took maybe about 3-4 years. But today, if I may dare say, almost 80-90% of the corporates are on the new tax regime, and rightly so. Because the last thing you want is to talk about deductions, exemptions, litigation surrounding those deductions and exemptions. The new tax regime for individuals has just been a year old, and it takes some time for any regime to settle down. And I would actually very much encourage that people need to move more and more towards the new tax regime. There is, of course, this whole fashionable ask that we need more exemptions and more deductions. I would rather have a far lower rate of tax than the government using tax to promote any of the policies that they need to do otherwise. So as we saw, for example, again, giving a corporate perspective, that instead of having tax deductions and exemptions, you had a PLI, which you put money in people's hand. Similarly, for individuals, we need to move towards a simple, rational regime. I mentioned earlier on, and I might like to sort of re-emphasize that there's need to reset the threshold limit every year. We have inflation. In fact, for capital gains tax, for example, we have cost of the acquisition index. Same thing, really, we need to ensure that we keep on moving the index of exemption up all the time. And I think the government would do very well to promote, do everything and more to promote the new tax regime and to increase the threshold limit. Remember that when the government increases the threshold limit, and I've done some working, shared it with CNBC, a 1 lakh rupee reduction in the threshold limit, or rather increase in the threshold limit, means that the government loses tax revenue by about 1,37,000 crores. We are looking at a point of time when the government's revenues are at a record, whether it is in terms of GST, whether it is in terms of direct tax. A 1,37,000 crore reduction in taxes actually does not mean that, because a lot of that money goes to people who are going to use it for consumption. And when they use it for consumption, you are giving a flip to the FMCG sector, you are increasing your GST collection. So I would be very much in favor of government doing everything and more, A, to increase the threshold limit, and B, to make it more attractive for people to move to the new tax regime where we don't talk of deductions and exemptions.
Okay, got it. So increase the basic income tax exemption threshold. That could be perhaps one big sort of recipe on the personal income tax.
And move it all the way up.
Sorry, Mr. Kanabar, if you could say that again.
And move it all the way up also, not just the basic threshold, but really take the limits up all the way up.
And this is for the new regime, the concessional regime.
That's right. That's it.
Okay, and therefore it will get people to finally migrate from the old to the new. Let's see if that comes through or not. Very quickly, gentlemen, we're down to the last 2 minutes on this conversation. Pranav, what else? I know that I think rationalization in the TDS structures has been a long-standing ask. There was earlier this issue of angel tax. Not sure if that has been fully addressed or not. I mean, what would be the other, let's say, 1 or 2 most important issues that you would want the finance minister to consider from a direct tax standpoint?
Right. So I would feel one is there are various anomalies under the 56(2)(10) where shares are acquired by taxpayers and the price moves up between the date of acquisition, the date of the signing of the agreement and acquisition. That needs to be addressed, which is a gift tax provision which applies to acquisition of shares. And in many cases, we have seen that impact transactions and deals where acquisitions of shares are happening. I would feel the government needs to increase the limit for interest on housing loans, which has been at 2 lakhs. I think a minimum increase of from 2 lakhs to 3 lakh is something that might be called for. A good standard deduction increase is again something that has to be considered. Also, long-term capital gains are exempt currently up to 1 lakh. I think that limit also in line with inflation needs to be increased to probably 2 lakhs or so that we invite even more taxpayers into the financial investment space. So these are some of the things that are, of course, boosting consumption as much as possible.
Take your point, but I'll tell you, with the current tax regime, you're getting 40,000 crores of retail inflows into the market on a month-on-month basis. So if you give more tax stops, then I don't know what's going to happen. The market's going to maybe explode. But anyway, we're not here to comment on that. Mr. Maru, if you could sort of wrap this up, you have the last word. From a capital market perspective, no change, yes, that is the big demand. But anything else? Anything else which you would want to see?
So I would say from a general deal-making perspective, 2 asks. One that Pranav specifically talked about on the gift tax. It started as an anti-abuse provision. It has almost becoming like a gift of taxes given the way the section is worded. We need like very, very general safe harbor rules to prevent genuine transactions from coming under this net. That's one. The second thing I would say is on the new tech space, I think our IPO markets are booming thanks to a lot of retail participation, institutional investments. And in particular, our markets are outperforming NASDAQ and many of the other markets. And it's seen a wave of new tech IPOs sort of coming in. What I think would be good for the market is if the government came up with very, very broad-based exemptions, allowing companies that have overseas shareholding to migrate their shareholding into India in a tax-free manner. This is not a free lunch. All you're doing is exempting a reorg to bring these companies back to the public markets in India. You could, of course, tax them when the shareholders eventually exit in an IPO. So to my mind, this would be another large thing that you could consider from a capital markets point of view.
Okay, all right, gentlemen, thank you very much. I'm sure we'll have some more rounds of these conversations before we, actually get up to B day. But thanks for your perspective on capital gains and, of course, other important elements of direct taxation. Well, with that, Rima, I guess almost out of time on this conversation on taxes, of course, on the market.
And we're going to take your leave then. Thank you very much for watching the show.